Oh, hey, what's going on, you guys? Still kind of messing around. All right. So what I'm hoping here is that right now the sun is on my computer, and then now the fan is blowing. So let me know in the comments if you guys hear the fan in the background. That's going to be really helpful for me, so that I can actually fix that real quick, and I can change maybe the microphones, maybe even put my headphones in or something like that. So just let me know in the comments if you guys are seeing or hearing any sort of fans in the background. Anyway. We got a lot to talk about here today. So there was a lot of interesting things that ended up happening last week, especially with the FOMC rate decision. Also, like what Jerome Powell ended up saying about the future direction of the markets. If you guys remember, they ended up holding rates steady, and then they also came out a little bit more dovish and actually said that they were going to reduce the pace of QT, which is going to be that balance sheet runoff. And I think the expectations were it was going to be reduced down to 30 billion. And now and this is going to be just for U.S. Treasuries, but they actually ended up doing 25 billion, which is actually a little bit more dovish than they anticipated. This is to make sure that there's still liquidity in the market, so it does reduce a lot of that tail risk that we do see with a lower liquidity environment. When I say liquidity, I'm more or less talking about like U.S. Treasury market liquidity. So if you guys remember back in 2019, that was one of those moments, like when the repo market was about to blow up. That was one of those moments where you actually ended up seeing like a reduction in a lot of the liquidity of that market, and rates ended up surging. I can't remember exactly how much, but they ended up surging, and then that does have a chance to create systemic risk in the system. So this is a good thing. It does reduce a lot of those chances of systemic risk, but I think that the real story here is like what's going on with the economic cycle. What was Jerome Powell talking about? Like, how is he viewing the economy on a forward-looking basis? Like, how many rate cuts are we actually going to end up getting this year? Or more importantly, like, what is the bond market pricing in for rate cuts now? And how does that actually impact our individual investments? And that's what I wanted to talk about here today. But then more or less still even talk a lot about like earnings. I mean, right now we're in the middle of an earnings season. Apple ended up releasing earnings not too long ago, which was one of the bigger ones. Also, in my opinion, I obviously have my own opinions about Apple. I think that I was going to talk a lot about it today, but it's a super divisive stock, and I'll just simplify it and really say that when a company starts to become really mature, like Apple is, what they do is they try to make sure that they prop the stock price up through the use of dividends or stock buybacks. But if they have $100 billion to really burn, what they should be doing is actually investing into the next leg of growth. I don't think that services is going to do it. I don't think that the Vision Pro is going to be it at all either. So I think that with Apple, I think it's a mature business model that should progressively see weakness with the stock price over time. I think that the valuation right now is extremely high for basically a company that's contracting in growth. But hey, what Wall Street's going to pay for is what Wall Street's going to pay for at the end of the day. But I do think that there's a lot of other earnings that I wanted to actually talk about today, not just Apple. So last week we had AMD, which was a big one here too. And with AMD, I do remember, so like, I didn't even actually pull this up, but I do think that we should actually go over AMD's earnings here real quick. So like I said, just bear with me just a moment here. So what a lot of people are missing, so they saw the headline numbers for AMD, right? And when they actually look at the headline numbers, I'm just going to share the screen so you guys can see what I'm looking at here. With those headline numbers for AMD, it's pretty easy just to look at them and say, and write them off and say like, oh, they're not growing as fast as NVIDIA. But what you got to really see is like AMD is at the very, very bottom of their data center journey. Like they just ended up starting to scale their MI300X, which is taking some market share. I don't know how much exactly it's going to take. But when you really break down the numbers and you see that, they didn't really grow too much, right? So they only grew about 2% year over year. That's what it looked like from a headline perspective. But when you look deeper into the numbers and you look at exactly like how they're where that growth came from, that's going to be the data center, which ended up growing about 80% year over year. So right now they're saying that it's about 2.3 billion for their data center. They think that they're going to scale I think that just the MI300X, like their data center revenue, up to about $4 billion by the end of this year. So that's a lot. That's quite a bit of growth. I mean, that's well over, I think that actually ends up being about 100% plus growth on a year over year basis. And then they also had the client segment that was actually performing really well. But it's not necessarily the client segment that I was really thinking about, is actually this gaming segment, and then also the embedded segment. So if you can look at just making sure, like, this gaming segment was down 48% year over year. When they guided, they said it was going down even further in the back half of the year. Same thing ended up happening with embedded. So like, what does that mean, right? So like, if you pay attention to the earnings call with AMD, what they're doing is they're actually changing their business model. This was really apparent, like when I was listening to their earnings call, like NVIDIA, what they did is they successfully scaled into more like a data center, because they're not really they are a semiconductor company, but they're doing a lot more work with supercomputers. But like now AMD is doing something similar to that too, where they have the MI300X, and they also have that data center, like in software revenue, that's actually going to start coming in as well. So I don't want to say that they're doing exactly what NVIDIA is doing, but it seems extremely similar to what NVIDIA is doing. And they're much earlier in that phase, where I think NVIDIA started probably about 2 years now. Yeah, probably about 2 years from today, when they actually started getting in more into the data center, like how they are right now. But now, obviously, NVIDIA is at the bottom of that S curve there. So I think that when you look forward in the future for AMD, and the reason why the stock still holds a premium valuation is that as it stands here today, it looks like it's 2% revenue growth, but gaming revenue is going to continue to decline, while data center is going to continue to expand and become a higher portion of revenue in the future. And there's also a sustainable secular tailwind for data center revenue. And then more importantly, like the clients are a lot more recession proof than, like Joe Schmoes, like people, just normal people that are just buying their computers or PCs or whatever it might end up being. We're going to be doing business with the hyperscalers like Microsoft, Google, and Amazon, and even Tesla. But I don't think Tesla I'm not sure if they have any MI300X. I haven't heard any announcements of that, but more or less, like that's high level with AMD, is that they're changing their business model and becoming more of a data center play. But I do think that where I actually wanted to start here for today's conversation is actually, I kind of had a smart ass thing, like, let me just pull up a picture or an image of, hold on, for whatever reason, I'm not sharing my screen anymore. 1 second here, guys. Okay, yeah, there we go. So what I wanted to do is actually show you guys a video here of a car company. No, you should really take a look at that, though. Tesla Optimus robot was actually pretty cool. So I'm just being a smart ass with this one. Okay, anyway, let's actually talk about like what ended up happening with FOMC here, and like rehash a lot of the language, what ended up what Jerome Powell ended up coming out and talking to us about. So they ended up holding rates, right? So they ended up holding rates steady at about 5.25 to 5.5 basis points. Now this is important, right? Because what they ended up saying, and like I mentioned before, they lowered the pace of QT, but it's not necessarily just like what ended up happening today. It was the forward guidance and what they were giving us. So Jerome Powell, in my opinion, he did come off a little bit more dovish than I expected, specifically when he was talking about like future rate hikes, and then completely tabling the conversation as far as rate. Sorry, what I meant to say is that he tabled the conversation with rate hikes, and he's still guided towards rate cuts over in the future, like in the next, let's say, 6 to 9 months into the future. Now, that was a really big deal when I ended up hearing that, because when you actually looked at the betting odds in the bond market, they actually ended up starting to price in a rate hike. I mean, it wasn't very substantial odds, but they did start to price in, higher for longer and the potential of a rate hike due to the recent inflation readings. But what ended up happening is that we ended up getting jobs data, which, just so you guys know, Jerome Powell has openly said many times before that he does get this data release before. So like if he has an FOMC, let's say 2 or 3 days, like this last week, 2 or 3 days before a major data release. So like this into last week's example, jobs data was that Friday, and then Jerome Powell was talking that Wednesday. So he did get the jobs data before. And he ended up seeing that obviously what we're experiencing is we are experiencing weakness in the labor market. Now, what's important to pay attention to is it's really more important to pay attention to like the overall trend. Sorry, man, I feel like I'm just stumbling up on my words. It's more important to pay attention to the overall trend, how you actually see average hourly earnings going down compared to, and not only that, but it's also like the payroll sector growth that's continuing on a downward trend. Everything is coming more back into balance. The unemployment rate is going back up. And then this is a really important tab that I actually wanted to show you guys here too, where you actually see that rise in permanent job losses so this is historically indicative with, so like you start to see this go up during recessionary periods. So the reason why this is important to pay attention to is that, especially the jobs market data, is that Jerome Powell has mentioned multiple times, every single time on his FOMC presser, is that he said that in the event that there's a weakening in the labor market, they are going to cut rates. And if they cut rates, when there's a weakening in the labor environment, what that's going to do is that's actually going to ease a lot of the interest rate sensitive sector of stocks. It's like a Dr. Seuss book. But like I'm talking about the end phases of the world. I'm talking about like the Teslas of the world. So like the vehicle market, or even like software stocks in tech companies, which are interest rate sensitive. So a lot of those other companies that are going to be, basically think about it like B2C, right? Consumer, big durable goods. A lot of those companies should actually see, and that also goes for like furniture companies and the housing market and a lot of those other sectors that are going to stand to benefit from a lowering in rates. So if the unemployment rate goes up, Jerome Powell mentioned many times that he is going to lower rates, and that doesn't matter. So like, I know that bears always come out and they say like, oh, he's never going to lower rates. Inflation's never going to go away. It's like, no, you got to look at the trend, right? And I know that that's historically been accurate, where if you look at the trend of inflation, it is going down. And then not only that, but the labor market is weakening. So yes, do we have some hotter CPI reports or PCE reports? Yeah, we got a couple, but it wasn't like outstanding to the point to where it was actually going to really make the Fed nervous enough to say, yeah, maybe we do need a rate hike. And that's really, excuse me, I had to hiccup there for a second. And that's really shown. So after the jobs data ended up coming out on Friday, and after Jerome Powell ended up talking on Wednesday, what they actually ended up doing, the bond market actually ended up pricing in more rate cuts for this year, specifically two. So like this next June meeting, we have high odds of not doing anything. So we're going to do another pause. Now, July could be our first rate cut. It's about 34% odds. We got about like 2 or 3 more, both inflation and jobs readings between now and then. But it looks like September is like when we're going to actually get that rate cut. And it seems like by the end of the year, now we're actually pricing in about 2 rate cuts. So right now we're at about this 5.25 to 5.5 is our current interest rate. So now essentially the market's saying like, hey, 30% odds of 1 rate cut, 36% plus odds, because I like to look at this distribution curve right here, plus odds of actually 2 and maybe even 3 rate cuts. So the reason why this is important, dang it, man, I'm not showing my screen. Okay, this is what I was just talking on. So you can see on December here that was the probability curve that I was talking about. So now why this is important is that for how the sectors are going to move. So for the first part of this year, if you guys were paying attention to like a lot of the long duration and high growth, long duration stocks, a lot of these companies actually have been seeing a lot of weakness. So there's been a lot of general weakness in the NASDAQ. X probably, like the data center names like NVIDIA and anything attached to NVIDIA. And then also some of like the larger cap, durable moat tech stocks like Microsoft, obviously, and Amazon has had a terrific year. Meta has had a good year so far, even despite the recent selling. So like a lot of those large cap tech stocks, they've actually seen a lot of tailwinds this year, but a lot of other companies outside of like the Mag 7, including the NASDAQ, and a lot of the like small and mid cap tech stocks, they've actually been selling off really aggressively to start this first part of this year. That has been directly correlated to the 10-year yield. So in the beginning of the year, if you guys remember, there was like 4 or 6 rate cuts actually priced in, and that was in like January, February timeframe. And then up until about 2 weeks ago, they were actually starting to not price in any rate cuts for the majority part of this year. So when you have interest rate sensitive stocks, especially when the valuation is sensitive to those interest rates, what ends up happening is that you actually see a contraction in the multiple. So now what we're looking at, and this is a big reason why high beta stocks rallied on Thursday and Friday, is that during that time frame, this is actually like what the market's essentially saying is that like we're at peak rates right now. This peak rates is important when you're thinking about like, do I actually want to buy long duration stocks? Because if we're at peak rates and then the rate expectations, so additional rate expectations actually start getting priced in, what's going to happen is that a lot of these stocks are actually going to end up rallying probably from now for the rest of the year, at least until there's some sort of recession. So like some sort of deflationary concerns, whatever it might end up being. But what's really interesting, and I wanted to show you guys this too. What's really interesting is I'm not sure how many of you guys around about 2 or 3 weeks ago when I was talking about what I thought that the markets were going to do, and they're actually following the exact pattern that I thought they were going to follow. Or we're going to get that ABC down. So like what I like to do when I'm analyzing the markets is I like to think about it from like a technical perspective, a macro perspective, and a fundamental perspective. Like the fundamentals being like, what are corporate earnings doing? Like what are the valuations of the individual stocks? What are the valuations of the indices? Like what are large caps trading at? What are small caps trading at? That's like the fundamentals. The technicals is obviously what I'm looking at right now. And then the macro is like, where are we at in the economic cycle? And what I try to do is I actually try to think about all three of those components together and then try to develop a picture of where I think that the markets are actually going to go, over the next 3, 6, 9 months. And I ended up putting this together, and I haven't even touched it since this last meeting, or since 2 weeks ago, like I ended up mentioning. And what I thought was going to happen is there's going to be like an A down, and then a B wave up, and then a C down, and then just basically like revisiting that 200-day moving average. So that's actually what's playing out right now. Right now we're at that 50-day moving average, which did act as a line of resistance, and that's historically what does happen. So you can even see like right around in this area that when we were rejected, and this is in the 2022 bear market, this was rejected. The 50-day moving average usually acts as that line of resistance. So if I were to just say like what's going on from a technical picture, it's pretty encouraging to see the MACD curling up like this. But at the same time, it's like this does look like a relatively bearish structure. I do think that there's going to be another wave down. That's basically what it looks like on a daily basis and on a weekly basis. You still have that weekly MACD curling over, which is signaling that there's a longer term downtrend at play. That's in the S&P 500 level. Not only that, but like usually during correctionary periods in the markets for the SPX, usually it's not completely done until it reaches like this 50 RSI level, and we're still above that. So you can even go back all the way back to here, where you even have like mini corrections. It comes back down to that 50 RSI level, and that's historically the trend that ends up happening. And we're still not there. Like we're still a little up. And once again, like I ended up mentioning, this does seem like it's an incomplete pattern. Like it wouldn't make much sense when you're just looking at the markets from a technical perspective to just see it go, down. And then all of a sudden, you're just going to see a gradual uptrend from here. And the markets are already still up about 4% year to date. So if you even think about it from like a probability perspective, and it's probably like from a probability angle, the markets return about 9 to 9.5% on an annual basis. I think right now that the markets are up about 4.5%, if I'm not mistaken, maybe 5%. And we're not even halfway through the year yet, because now we're in May. So now we're 5 months into the year. So that tells me that, it just seems like that it would be really healthy for the markets to continue to pull back. That's just from a technical perspective, right? So like I mentioned, this is kind of contradictory where I'm talking about high beta stocks, and I think that they're actually going to rally because interest rates are going to, I think that we're actually at peak interest rates. But at the other end of the side, or at the other end of the spectrum, like I mentioned, with the markets right now, it does look like from a technical angle that there is something to be, let's just say, wary of. I think it makes a lot of sense to, like, especially if traders, people who are like, that really care about those short-term moves. I do think that there is like something to be wary of and cautious of. What's going on, Mike? Wait, no, Speedy. Yeah, Speedy. What's going on, dude? But I do think the traders, I do think that they have something to be cautious of because I do think that there's going to be a short-term, it looks like that there's going to be a short-term pullback. It does look a little bit more on the bearish end of things. It's an incomplete Elliott wave pattern. So there's just a lot of things going on. But I actually wanted to talk a lot about earnings that are upcoming this week here. Actually, let's talk briefly about the NASDAQ here too. NASDAQ is really showing a lot of the same things as the S&P 500. So on a daily basis, it's basically identical. It looks like it's an incomplete pattern where it does seem like it actually wants to continue to go back down, but it did recapture that 50-day moving average. It does seem like it actually hit that oversold area, which is, man, that's really crazy. That's crazy. Okay, so it looks like tech stocks want a bottom because right there you got that the daily RSI ended up reaching those oversold levels. And I guess I'm not really sure. I guess I'm really not sure because it does look like, I mean, it's contradictory where it says like, it's basically saying like the indexes may not have, like the broader index may not have very much upside, but tech, could actually outperform, which would be pretty conclusive with what I'm talking about when it comes down to peak rates. So that's definitely something to pay attention to. But I do think that it's not just the technicals or the macro that are going to be a big deal about this. I do think that it's actually going to end up being earnings that are really going to play a role into this. So if you guys have been paying attention here to, let's say, Microsoft, Google, Apple, I don't think NVIDIA has reported yet, even Tesla, Meta. So all those big companies have already reported earnings. Especially the larger, so like the hyperscalers, Google, Microsoft, and Amazon, really released some great earnings. And there is a lot of strength right now in a lot of the B2B tech, especially a lot of those infrastructure stocks. So like data center infrastructure stocks. And I'm not talking about just the hardware. I'm actually talking about the software end of things, specifically around artificial intelligence and the applications that a lot of businesses are doing right now, both with the Gen AI perspective. And then I don't even really know exactly what sort of artificial intelligence programs they're actually running. So I think I got to learn a little bit more about exactly what they're doing. But I do understand that Palantir is going to be reporting earnings this week. So I got 5 different companies that are going to be reporting earnings this week, or 6 different companies. We got Palantir, Symbotic, Datadog, Navitas, Shift4, and then the Trade Desk. Those are 4 that I'm going to be watching. Sorry, 4. Like I can't actually count, right? No, those are the 6 that I'm actually going to end up watching here this week. But I do think that there's going to be a lot of other companies that a lot of other people are going to be paying attention to. So we got Palantir. I'm going to be watching that one. I am going to be covering that one too. I'm very familiar with Palantir. We're going to talk more about them in just a second. We're going to talk a little bit more about Symbotic. But I do want to talk a little bit about Hims and Hers and Axon. So that's what I know that a lot of other people are actually invested into, like the Axon. If you guys don't know that company, it's actually going to be like a body camera / software company for policing companies. What they do is they actually sell like tasers and body cams to a lot of the policing departments all over the United States. Their basically motto is to not have lethal force, but a lot more of like the, I guess, restrictive. Like there's going to be force be used, but it's not going to, provide, like harm the individuals long term, if that makes sense. Like basically shoot them. But then you also got Hims and Hers. I think that so if you guys do have Hims and Hers stock, I think that I when I was looking at this company, the first thing I ended up thinking to myself was like, man, you got to look at those reviews, the customer reviews as well as the employee reviews. Like it's actually pretty alarming when I ended up reading about what they're doing from a business perspective and how there's really no customer service, I think. So if you guys do own the stock, a little bit more due diligence, just going to put that on your radar to make sure that you're actually going through and looking at a lot of those customer reviews, because I do think that customer service is very important to the long-term sustainability of an individual brand. Man, I cannot talk tonight. Individual brand. Okay, moving on. And then we also got Celsius going on Tuesday morning. So Celsius is going to be reporting earnings. A lot of people care about that company. I don't have very many opinions about it. I've never really invested into an energy drink company because Monster's out there. I think that Monster's dominating the market, and they're going to continue to dominate the market. I'm going to talk more about Datadog here in a second. And then Uber, Shopify, and then Toyota, Airbnb. Those are the big ones. The Trade Desk is also going to be one that I'm going to be covering. Duolingo, I know Brad Freeman's going to be covering that. And then also we got, I'm not sure if you guys have actually seen GCT, so Gig Cloud Technology. I checked it out. It's a technology, or it's a Chinese company, so it's kind of like on my no-fly zone. I don't necessarily want to own any Chinese companies just because I've been around enough to be able to see that I've never seen some volatility like I've seen in Chinese stocks. Like it doesn't matter if it's a value stock or not. It just seems to never want to catch a bid. It just really goes back to show that the only thing that Wall Street really cares about at the end of the day is like what they want to buy. and that's the stock prices that is actually going to move at the end of the day. And then I think Shift4 is gonna report on Thursday, if I'm not mistaken, but that's actually not on here. And then you also have DigitalOcean. I know that there's some people that actually own DigitalOcean. For me, I'm not a big fan of the CEO change, so I like to know exactly who the CEO is of an individual company, which is a big reason why I don't invest into companies like Hims and Hers. It seems like that when political ideologies start to supersede like the overall fiduciary duty to the individual shareholders, it seems like that there can sometimes be a conflict of interest about exactly how they want to run the company. So that for me, from my perspective, is something that I usually don't do. So what I wanted to do is actually talk a little bit more about some of the individual earnings that we have coming up. So Palantir. All right. I've been holding Palantir for, it's probably been about 2 or 3 years now. It's one of the companies that have been my best performers. So I've been following along with this company since probably IPO. Is when the first time that I ever bought shares. It was actually an IPO, and that was back in 2020. So that was the first time I ever bought those shares. And I've been following along with the business and the story of the business and how things have really been evolving over time. So Palantir, what they're doing, so the expectations is 8 cents on 617 million, and this ends up being about 18% year-over-year growth from a top line perspective. So revenue is expected to grow about 18%. But the story here with Palantir is actually going to be AIP. So AIP, this is essentially I don't want to call it just a large language model because it actually integrates with their customers, right? So they actually integrate Foundry or Palantir within a customer's existing data infrastructure. And then what they're actually able to do is they're able to run those large language models and then also run predictive and prescriptive analytics to help make them better business decisions. This can get really into the weeds, but I'm going to stop there, right? And that's essentially, this is like legitimate enterprise AI. And this has been seeing a massive acceleration in, especially from a customer account perspective for Palantir. I think that last quarter they ended up posting, don't quote me on this, but I think it was like 50 or 54% year over year customer growth, commercial customer growth. So when I ended up seeing that, I don't necessarily know where this S curve is going. I do think that Palantir is in an S curve, and despite Palantir being one of the most expensive software stocks on the market, it's one of the only software stocks that, so like for example, Cloudflare ended up reporting earnings on, I think it was Wednesday, I think it was actually Thursday night. And then Friday, they were down 15, 16, 17% the next day. But the thing is that a lot of people didn't really pay attention to is that going into earnings, they were actually at a really premium valuation. I think it was like 19x next 12 months EV to sales. When it's actually at that premium valuation, and it falls like 15 or 20%, it really only fell to about 17x next 12 months EV to sales. And this is still a premium valuation where historically companies that are growing 30 to 35% free cash flow positive in their software stocks, usually they trade at about 12, 13, 14, and 15 on the high end. Next 12 months EV to sales. So Cloudflare, despite its weakness after earnings, is still carrying a premium valuation. So Wall Street still favors the individual company. Now, CrowdStrike and Palantir and Samsara are the other companies right now that are carrying those premium valuations. And Palantir being one of the only ones that I'm watching going into earnings, and I'm like, okay, what exactly are they growing at? Because it is important to exactly know, like, so from a future perspective, like what is the commercial customer interest that we're actually going to be seeing with Palantir and for these AIP products? Like how big can commercial be as a percentage of revenue compared to their government revenue? And is there going to be an acceleration in government revenue in the future too? Like there's a lot of optimistic things going on. So I think that's exactly what I'm looking for Palantir. It's like, I want to know more about exactly, right here, I think from HSBC, the company's commercial business is witnessing a strong acceleration, especially in the US. A demand for companies' AI platform remains strong, right? And that's exactly what I'm talking about. So what I want to know more is there a slowdown in any way, shape, or form to Palantir's AIP business? If there is a slowdown, then I think that we're actually going to see pretty substantial weakness in the company's earnings the next day. But I mean, right now, I think it's trading at like a 17 or an 18x next 12 months EV to sales. So there's really not too much upside for the stock to move right after earnings. So I think it's a lot more along the lines of like, is Palantir going to come out? Are they going to beat expectations? And if they do beat expectations, is it going to be enough to maintain their premium valuation? Because Palantir has ran up pretty substantially. And I actually pulled this up for you guys to really put better context as to what's going on with Palantir. So this is actually from finchat.io. Finchat.io is really a great resource that I use pretty consistently. So finchat.io, what I pulled up here for you guys is this is the valuation of Palantir. This is going to be the next 12 months EV to EBITDA, not EV to sales, but EV to EBITDA, because what they are doing is it's not are they just growing their revenue 20% plus, but they're actually expanding their bottom line metrics pretty substantially and rapidly too. And you can see that here in both the purple line, the orange line, and the black line, because that's going to be your free cash flow, net profit margin, and EBITDA margin. So you can see that all of them are going up rapidly. And they actually ended up scaling to GAAP profitability, and you can actually probably see GAAP EPS start to accelerate as well. So even though that they're actually experiencing this accelerated revenue top line growth, they're actually expanding their bottom line growth even faster than that. So I'm not exactly sure, because they just ended up hitting scale. So I don't know exactly where that's going to top out at. That's something I'm also going to be learning or listening to in the earnings too, is like how profitable can Palantir actually be? So I think that Palantir also gets like a really negative connotation for being a cult stock. And it is a cult stock. And I hate cult stocks. I own multiple of them, but I hate them. And I hate them because what ends up happening is that you end up getting a lot of like echo chamber, rah, like nothing can ever be bad about this company. And it's like, that's bullshit. You actually want to hear, holes being poked in your thesis. Like I want to know what is Palantir not doing, because that helps me strengthen my thesis. Like I don't always want to be a part of those cult stock movements, because it's just like euphoric bulls are just as bad as overly pessimistic bears. You want to stay balanced. You want to stay nice and steady and in between. But here's the truth of Palantir. It's a profitable software company that's expanding bottom line metrics rapidly and growing 20% plus. And the likelihood that they're going to continue to grow 20% plus for years into the future is extremely high. And not only that, but there's also an extremely high switching cost to Palantir. Like once you actually land, like when Palantir lands a customer, it's extremely hard for that customer to scale back on Palantir, but it's also extremely hard for that customer to replace Palantir, because not only is it just locked in for like a multi-million-dollar contract, but it also integrates within the business workflows. So this is an extremely sticky company. So like when you have a sticky company with recurring software revenue, coupled with expanding GAAP profitability, coupled with 20% compound annual growth for the foreseeable future, like you just have a winning recipe here for this company. But I still, like I mentioned before, I still concern myself with like exactly how high, and let's actually pull this up here, exactly how high the forward valuation is right now. So if we even look at next 12 months EV to sales, so you can even see from like a price to sales perspective. So like this green line right here is actually, and what we can do is we can actually cut out some of this noise. So you can even see from a price to sales perspective, it looks pretty aggressive, the kind of multiple expansion that we've seen. So, if you bought Palantir around 5 to 6 forward price to sales, you made out like a bandit. But like right now it's trading at 18.13. Like that's extremely high. That is despite even the bottom line metrics expanding so rapidly. So we need to make sure that for Palantir shareholders, we need to make sure that we're paying attention to that EV to EBITDA. Like what sort of scale is this company actually going to have? Okay, so then I actually wanted to talk. Let's move on to the next company. I wanted to talk about Symbotic too. So Symbotic. All right, this one is actually a really tough one for a lot of people to understand. So I'm going to talk briefly about the business model of Symbotic and then talk about their expected results. So Symbotic, hold on. I'm seeing something that I'm not getting. I don't know. So I got a notification here where it says that my browser has lost connection to my screen share audio. Okay, let me know if you guys actually are able to see my screen or not. Because let me actually just stop sharing my screen. I'm going to try to represent it here and see if I can keep talking. Okay. Let's see. All right. Hopefully that solved whatever issue that I may have had. Okay. Let's talk a little bit about Symbotic here. So what I want to do is actually provide better context. And like I mentioned before, guys, these are always live videos. So, you know, kind of get what you get with live videos. It's like I do the best that I can to make sure everything's nice and smooth, but sometimes technical issues, they just kind of happen. Okay. So let's talk about, hey, thanks, Speedy. Appreciate that, man. Let's talk about Symbotic. It's a robotics company, right? But what they do is they actually, man, I should have pulled up some of these slides here. So I'm going to talk while I pull up some of these slides. And I'll share this screen here. Let's do Symbotic Investor Relations. So then it's easier to show you the pictures of what this company, you know, like what it actually ends up looking like. So Symbotic, what they are is they are an artificial intelligence and robotics company, right? So what they do is they actually integrate robotics within logistics and supply chain warehouses. So yeah, so what they do is they basically handle boxes. And this is perfect. This is a perfect image to show. So what we're looking at right now, and I got to make sure that I'm actually sharing the screen. So it's not actually working with me here. Let's see. Let's not do that one. And then let's do, I'm going to share this screen. Okay, right here. There we go. Perfect. Okay. So what this actually, so this is exactly what Symbotic's overview looks like, or what it actually, like their solution looks like. This picture, I mean, it's pretty big, pretty hard to see, meaning that it's like, it's hard to know what you're looking at unless you actually know what you're looking at. So this is essentially put into a warehouse, right? This entire system, and it is a system. And this little green thing right here, this is called a Symbot. And all these Symbots, what they do is they operate within this blue, I don't know what you want to call it, like a blue city, right? It's basically like a mini city full of Symbots, and they can essentially organize and make sure that all the boxes are being organized effectively into certain areas, and they're all autonomous too. So what this actually ends up doing is that this saves people, like their customers, millions of dollars a year in overhead costs from both labor, and then also decreases the amount of damage that ends up happening to these goods, right? And this is just where they're starting here today. And then they ended up booking I think like a $20 billion or maybe like a $12 billion deal with Walmart as a proof of concept. And now they're landing new customers every single year. So Symbotic is, I mean, this is like a big idea, right? And I'm not oblivious to that. And I know that, and I understand that it seems pretty speculative, but that's the whole reason why I'm going to be really paying attention to these earnings, is that I actually want to know what's going on with their backlog. Like, are they gradually working through this? And I mean, man, I can talk about Symbotic for a whole freaking video, I swear. But are they actually working through this backlog? And more importantly, like, how is their EBITDA margin starting to expand? So when you actually look at Symbotic's EBITDA margin, it's been expanding rapidly, to about 19%. So this is only over the course of about 2.5 years. And they are free cash flow positive. So I actually pulled this up for you guys too. And they are free cash flow positive. This last quarter was the only quarter that they weren't. And I think that's why it ended up selling after hours. And then you also have the EBITDA margin. So the free cash flow, they are operating free cash flow positive. They are operating at a non-GAAP EBITDA profitability. And then they're also they should actually be GAAP profitable probably within the next year. So this is all of this is really important to the overall thesis of the company, right? Because I think they have like $550 million on their balance sheet, no debt. And not only that, but it's like there's just a lot to be able to, man, I'm trying to be super concise about Symbotic, but I have so much stuff going on in my head at the same time where I'm just like, man, I got to tell them about this. I got to tell them about this. But it's like, I'm going to be, so like overall nuts and bolts, we got to make, I want to know more exactly what's going on with this backlog. So they have like a $22 billion backlog right now. Are they actually working through this? And they also have another thing going on. It's called Greenbox, and they're implementing like this warehousing as a service. Like I said, I can talk about this company for for hours, I feel like, because there's a lot to talk about with this company. But it's a really exciting company. They're growing extremely fast. I think that they're expected to grow. So let's actually take a look at what the expectations are. They're expected to grow about 40% this year. 47% this year, 42% the year after that, and 42% the year after that. And what we're looking at here is, like, once again, like I mentioned, non-GAAP profitable. We're expecting to see about 2 cents. They're expected to grow. I don't even know exactly what this ends up being. It's close to 100%. So this probably is about 60, 70% year over year to that 412, or they're looking for 413 is what Wall Street is essentially looking for. I think that they're going to beat both. They may not beat the bottom line. They're definitely going to beat revenue, as they usually do, because they operate on a backlog. Like a lot of the business that they have right now is already being booked and already being fulfilled. So the way that they recognize revenue over time is that as they continue to go about their project, they recognize revenue, which also helps them out with their cash flow margin. I think that what's actually going to end up happening is that they should beat revenue. I'm not sure about the bottom line because they're investing heavily into growth. They're also investing heavily into their ability to continue to innovate in the space too, because it's a big idea. Like, we're talking about warehousing as a service. We're talking about like AI and robotics completely automating an entire warehouse, right? That's what Symbotic is basically doing. And it is a big idea. And it is kind of speculative, but they have the balance sheet to be able to execute. And they have the leadership, his name is Rick Cohen, to actually be able to make this a reality. So what I really want to know is just really, like, I think I've said this like 3 times now, but to simplify, I want to know what's going on with their backlog. I actually want to know what's going on with this green box opportunity. Like, are they actually going to start recognizing revenue this year, or when can we start seeing revenue there? And then also, like, how are they rolling out their existing projects right now? Like, are they working on 6 different warehouses? Did they launch 6 new warehousing projects? Like there's always been like this confusion as to. And I think that this is a big reason why Wall Street isn't jumping on this stock right now, is that, like, there's always this confusion about exactly how much business do they have. Like, they throw out a number and they say we have $22 billion in business in backlog, and it's like, okay, so how many different projects is that? And more importantly, like, how sustainable is that for the long term? And even every single bear thesis, so like on Seeking Alpha, and I love reading this. So these guys do a good job. So every single bear thesis, and I think that I read about this one right here, Critical Quarters Ahead by Richard Durant. I read that one, and he's right. It's like, what does the future actually look like for Symbotic? And this is a make or break quarter. And not only just this one, but it's actually going to be over the next few quarters, because Symbotic right now, it's a $24 billion company. But if there's one company that I hold that actually has the ability to become a $300 to $400 billion company, it's Symbotic. And the reason why it is just like the way that their business model is set up, the uniqueness of the product and how they're actually positioned within their existing market, and like what the total addressable market opportunity is on a global basis. And like even what they can do with this technology, it's not even just warehouses that they can automate, right? It could actually be like shipyards that they could automate. Anything with boxes that's essentially what they're shooting for. So like Symbotic, I know it sounds super speculative. I get it. I'm not trying to be one of those euphoric, like, hey man, I'm going to just pump stuff. I really do think it has a legitimate shot. Like if I had to give it odds, I'd say there's like a 25% chance that it could actually reach a $300 billion company. So it's like a 0 or it's a $300 billion company. And that's it's not necessarily an asymmetric bet, but it's a bet that I'm willing to take. Okay, then we also have Datadog reporting. So I think that I wanted to talk about this one the least because I'm pretty confident about this one. Datadog is pretty expensive right now. I think it's trading at like a 15x or 16x next 12 months EV to sales. But what I think is, what I know is that Datadog is usually indexed pretty heavily to like Amazon AWS specifically, as well as Microsoft Azure and GCP, so Google's cloud. They're indexed really heavily to that. So whenever you see weakness in the hyperscalers, you see weakness in Datadog. When you see strength in the hyperscalers, you see strength in Datadog. Like it's been pretty consistent because what Datadog does is they essentially operate an observability and DevSecOps platform. Man, that can mean a whole lot of different things to a lot of different people. Let's just call it an observability platform, and it's basically indexed to like how cloud is going to continue to scale over the years. Datadog, I can talk about Datadog just like Symbotic for like the next 5 hours, right? Because I spend a lot of time actually like researching these companies and listening to the investor calls and whatever it might end up being. I think that really at its nuts and bolts, what people want to know, it's like, are they going to beat and what are the expectations? Yes, I think they're going to beat. They're expected to grow about 22% year over year. And they're actually expected to have like 34. Man, I keep hiccuping because I'm talking all the time, right? So 34 cents of non-GAAP EPS is what they're expecting to see. I do think that they're going to hit GAAP profitability. I think that they're actually going to be, let's see if they're even going to be, if they're expected to be GAAP profitability. Okay, not expected to be GAAP profitability this quarter, but they do hit some quarters, and it looks like in the future they're expected to be. Let's actually take a look at the annual. Okay, full year 2023, they were GAAP profitable. So that should be, should be one of those rare combinations of GAAP profitability and a software company at the same time. Datadog has an excellent leadership team. There's really nothing else that I can say about it. It looks like I got that stupid warning sign again. I'm just going to stop sharing this for just a second and just talk briefly about this. So Datadog really does have that unique, very, very unique position where they are one of those companies that should be GAAP profitable, should continue to transform their business model to GAAP profitability, and then consistently have that 120% ARR, which basically means like recurring revenue from existing customers, and then also have that really strong secular tailwinds. Like these are the companies that really excite me when I see GAAP profitability, secular tailwinds, excellent management team that continues to innovate rapidly. Like that's what I see in Datadog. And I do think that they're going to continue to do that, not just for today, but for years into the future. And if there is a possibility that like during a market correction, if you guys don't own Datadog, highly suggest taking a look at it right now so that when you do have a market correction, that this could potentially be a long-term compounding opportunity for whoever wants to have it. Speaking of long-term compounding opportunity, this is a company right now that's actually on my short list is Navitas. I keep doing this to myself. So Navitas is actually a small cap semiconductor company. And the thing about small caps and investing into small caps, so I got to just make sure I'm just throwing this up because I'm fully aware, man, it sucks, right? Small caps suck. They really do. Like everybody wants the steady eddies. Everybody wants the companies that are going to continue to compound, that are large caps, that are just trustworthy. Like we don't know if Navitas is going to be a 10X or they are US based. So Navitas is US based, but I don't necessarily know if they're going to 10X from here because they're only an $800 million company, or because their growth is pretty outstanding. Let me actually show you guys. So their growth is really outstanding. I think that they're expected to grow. I got to go back to my screen here. Okay. So they're actually expected to grow. They ended up posting about 100% plus revenue growth last year. They're expected to grow 43% or 42.59% this year. The reason why they ended up slowing in growth is because they do have exposure to the EV market and the overall EV market right now. It is really staggering. So it's really struggling right now. Mostly because from my perspective is actually high interest rates. Like I don't know anybody right now that's going out and buying a car. I'm not sure if anyone's thinking to themselves like, yeah, man, I want to pay 8% interest rates, right? When we just got done with like 2 or 3 or 4% interest rates. Big difference. And that's a big difference in the monthly payment. I mean, this is hundreds of dollars a month. You got to think about like the average Joe. Are they going to want to pay $400 a month for a car or $750? And that $350 per month is a big difference, but that's actually just a couple percentage boosts in an interest rate. So with Navitas, I think that there's actually a really good, strong long-term opportunity here. Right now, they're operating unprofitably, which just makes it an unbelievably volatile stock, and that's why I hate it because it is super volatile. Like it can go down 20% from my initial cost basis, and then it can rally 100% from my initial cost basis in like a 6-month period. Right? That's why I hate small caps. Like you got like when you have a company like this, you actually have to think to yourself, like, I'm going to put money into this that I'm willing to lose, right? So that you can ride it up and down and you can sleep just fine at night. So like, I mean, for me, I think I allocated like 1 or 2% of my portfolio into Navitas, right? Because I think that that's like hey man, this could become, a 10% position over time. It could actually get to a 10x position, meaning like if going from 800 million for a growth like a company like this, getting from 800 million to an $8 billion company means that they continue to grow like at this pace for the next like 4 or 5 years and reach GAAP profitability. If they do both of those things, this will be a 10x stock. If they don't, then they're going to go out of business, and this is going to be a big fat zero for me. But that's kind of, like I mentioned, it's just like a spec bet, right? What I'm paying attention to for Navitas in this coming quarter is I'm looking at margins, right? So with margins, this is a big story here. Thanks, Speedy. Appreciate that again, man. So with margins, what we're seeing here is it's like this is the whole story with Navitas is it needs to get to profitability. If it doesn't get to profitability, so like last quarter they were very, very close to free cash flow positive. Not the last quarter that they reported because it actually went down, but the quarter before that, where it was like negative 8.9%. Free cash flow margins, where it was like, oh man, this is getting really, really close to being a profitable business, at least free cash flow break even. But then they ended up having a couple hiccups in Q1, and then they did guide for another I should say in Q4. They did end up guiding for deterioration in margins in Q1, mostly because of what was driven, I really do believe, and it was pretty consistent with other things that I've heard, because of the EV market. With Navitas, I do think that they are going to recover throughout the rest of the year, but I really, really need to hear leadership tell me that they're going to take care of my capital. Basically meaning that they're not going to dilute me through additional share offerings, that they are going to make sure that they're managing their expenses appropriately. Like they got to make sure that they're actually scaling to free cash flow break even and eventually GAAP profitability. Because, like it doesn't matter if a business is growing 40, 50, 60, 70, 80%, 100%. 200%. It doesn't matter how much it's growing. If they're never going to be profitable, there's no reason to own that company. And that's a big thing that a lot of people don't pay attention to. So like, that's what retail investors, especially, I gotta do a mini rant. So retail investors, especially, what they do is retail investors, like individual investors, people who are not on Wall Street, they get so excited about the story of a company, and they get so attached to that story of the company that they never really ask themselves the fundamental question: is this going to be a profitable company, and how profitable is it going to be in the future, right? And I just got to like full stop there, because it's extremely hard to lose money in a company if they're profitable and if they're growing over time. It's not going to go to zero especially if you pay a reasonable valuation for it. Like that's the whole theology with Peter Lynch, Warren Buffett, and a lot of the great investors. Find companies that are profitable, that are growing revenue, earnings, and cash flow, and hold on to them, follow the business story, and make sure that they're continuing to gain a competitive advantage, or they have some sort of competitive moat over a long period of time. Full stop. Like it's actually that easy. But a lot of people, they end up getting caught up in, this analyst said this, and this analyst said that, and this new article came out, whatever it might end up being. It's like, are they growing revenue, earnings, and cash flow, or are they not? It's actually that simple, because it's extremely hard to lose money in a company that has $1 billion of cash on the balance sheet, is growing 30 to 35% year over year, is operating free cash flow positive, and has zero debt. Like that company is going to base out even in the worst of markets, even in the biggest of recessions. That company will eventually find a bottom, because eventually it gets to a point where it's like trading at a 1x price to book ratio, which is basically a dollar for dollar for every dollar that they have in assets compared to liabilities. Right now, this is a big deal, right? Because these are individual companies, these are individual assets, and when you have a good company, a good solid company with a good balance sheet, and is actually reaching that profitability, and actually, so like I do have a couple companies that it's like that I am betting on them to reach profitability. Navitas being one of them. SentinelOne is also the other one. Symbotic, kind of, they're already free cash flow positive, so we're kind of already there, but there's a lot more room to be had, right? So there's a lot of companies out there but here's another thing, is I've only ever lost money in companies that are operating at a negative free cash flow. Not kidding, right? Because I pay attention to the individual price that I'm paying for the company, right? So if I pay attention to the individual price, and if I pay the right price for that company, meaning like make sure that I say, hey, that this makes sense from a valuation perspective to buy this company. And then I pay that valuation for that company. And then because obviously the market's going to go up and down, there's the sentiment swings, whatever it might end up being. And then eventually from there, they continue to scale the free cash flow margin that they have. So they continue to generate cash from me as the shareholder over time. And then sure as shit, the company goes up, the stock price goes up. And people don't really think about it like that. They don't understand that. But there's a direct relationship between a company's ability to generate cash and the stock price. I promise you, pull up anything in hundreds of years of history. It's not as speculative as one would think. Okay, so back to Navitas, because I had to do a mini rant. This is essentially what analysts are expecting. So this is Navitas. I love Simply Wall Street because of this chart right here. This lets me know what the sell side analysts are thinking about from their cash flow perspective. What sort of cash flow are they expected to have? And right now we're basically in the middle of 2024. So we're right in this area. So analysts are saying, when I see something like this, when it's very close to being break even, in 2026, but it's not quite there, that tells me that analysts don't know. So they're basically saying hey, yeah, we do think Navitas is going to grow, but are they going to reach free cash flow positive, or are they going to continue to invest back in the business? If this is actually the realistic case, and if they're going to be about 2.5 years away from that, and they're operating at negative $25 million per year, I think that they have $100 or $110 million on their balance sheet right now. It doesn't make sense to hold this company. And this is exactly what I'm going to be paying attention to for this earnings. And I will cut the stock, because right now I hold about 22 companies, and I want to narrow that down to about 15. So I got to be very selective about exactly what I'm holding here. It's yeah, sure, if Navitas is going to go up 10x, okay, but if it's not going to become profitable, this company is going to go to zero. Just like any other company, it ends up going to zero over time if they can't generate cash. So next company I wanted to talk about. Man, I'm going about an hour with this one. I cannot believe I've been talking for this long. Anyway, Shift4. So this is ridiculous. Okay, I got to show you guys this tab. So Shift4, I pulled this up from finchat.io. Right now, what we're looking at here, the orange bars are the free cash flow that Shift4 is generating. This blue squiggly line is the valuation that Shift4 is trading at. So right now it's trading at a 8x EV to EBITDA multiple. And then they're also, so this blue line right here, this is going to be their forward EV to EBITDA. That's their EBITDA margin, their free cash flow margin. And then the purple line is their EBITDA margin. So you can see that both the free cash flow and the EBITDA is going up. So both of them are expanding. They're generating free cash flow. And their EV to EBITDA multiple is 8. And then, sorry, I'm just completely baffled by Wall Street right now. And I can't seem to figure out why it's even trading at this valuation. I understand that they have higher debt on their balance sheet, but at the same time, it's kind of why is this company trading at a 12x next to so 2025 PE is expected to be 12.6. And it's when I listen to these earnings calls and when I listen to what the business or what the leadership team is talking about, it's why are they trading at this valuation? It doesn't seem like there's a disruption to the business, because every single day it seems that we get these announcements here, expanding with the Chicago White Sox. Essentially what Shift4 is doing right now is they're actually going into ticketing sales and venue sales. So your favorite sports team, there's a very strong chance that Shift4 powers that entire stadium. Right. So they're going into that. They're also going into restaurants. They're also going into hospitality. So think about I don't know, hotels, right? Hotel or even resorts, your favorite resort. So they have a really pronounced presence within Las Vegas. So Shift4, okay. So the other thought process that I had about why I think Wall Street is actually discounting their current valuation is that I do think that they're paying attention to organic growth compared to acquired growth. They have acquired a couple different companies. And what I've noticed is that companies, sometimes their valuation will actually be compressed if they've went through a few acquisitions within the past, let's say 1 to 2 years. So that Wall Street, what they do is they look at the organic growth and they say, okay, what is this business organically growing by? And then what is the acquired growth from that organic growth? And then I do notice that Wall Street does discount that, and they don't assign like the appropriate valuation compared to if it was an organic growth. So that's another thought process that I have, but they haven't acquired a company for, I think, 1 or maybe a year and a half. So for me, it's still just this weird anomaly that it's like they're expanding their free cash flow margin. So it's either this is a value stock and it's going to 2x, or this company is, I don't know. Either that or I'm missing something crazy. So it's right now, I think it's trading at like $55 per share, $58 per share. I could actually see this being $120 by the end of the year. And that's just assigning it a 25x forward EV to EBITDA at 40% growth. Because I'm not sure if you guys saw this here too. Like, this is the sell side analyst consensus right now, is that they're expected to grow 45% this year, 27%, 21%. So they're expected to grow rapidly over the next few years, 20% plus. And it's trading at a forward EV to EBITDA of 8. Like, that doesn't happen. It's like there's something going on here that I don't know about, or this is actually this is a bargain stock. It's one of those two. So that's that. Like, what I'm paying attention to for their earnings call is I do need to see them beat expectations. So the reason why I want to see that is that this is a huge reason why I noticed that Wall Street, and I'm actually going to show you guys their last earnings, where it wasn't good. Like, it wasn't a solid earnings. But when Wall Street, or when a company beats Wall Street's expectations, this does give Wall Street the confidence to actually expand the multiple that it's trading at. And I can't find this. So what I noticed is that if they, here it is. I was just about to give up. So you can see that it actually missed earnings by, both top and bottom line last quarter, but they did reaffirm guidance. So what I do notice is that companies, when they miss expectations, they tend to have a compressed multiple. Companies that consistently meet or exceed Wall Street's expectations, I notice that they tend to carry a premium multiple. Think about like Cloudflare trading at 17x next 12 months EV to sales. Like, that's what I've noticed. And I do think that Shift4 is one of those companies that need to actually start beating revenue, or start beating Wall Street's expectations. And if they do that, I do think that the multiple is going to start expanding. So there's a very strong chance this week that if Shift4 comes out and beats expectations, that it's going to skyrocket right after earnings, especially if the call goes well and guidance comes in strong. So I think that that's one of those companies right now that I'm really, really paying attention to. I think that it has one of the highest upsides in my portfolio. The trade desk, we're getting long on time here, guys, but I'm going to just summarize the trade desk. The trade desk is pretty simple. Trade desk right now, I wasn't even showing you guys what I was looking at here in this last one. Okay, this is Shift4. This is what I was talking about, how they missed expectations last time. But the message is all still the same. I want to make sure that they're actually exceeding. Sorry, one of my buddies is calling me right now. Okay, so I'm on my MacBook, so it comes through my MacBook. Okay, I'm gonna make the trade desk super short and sweet. Trade desk, we're looking at about $480 million in revenue compared to 382. I think I did the math on that. It's like 18%, maybe 22%, somewhere between 18 to 22% growth year over year expected for the trade desk. I don't have a concern about the trade desk right now. The trade desk is it's just a wonderful company. I mean, right now I'll even just show you guys. I'll just have to show you guys just on Simply Wall Street. So I'll just share my tab here. The trade desk is one of those very rare companies where they have the growth and profitability to go along with it, and the free cash flow, like all around the trade desk. And not only that, but their CEO is pretty exceptional as well. So you can see that they've just been growing free cash flow, operating cash flow, EPS, and revenue, and they're expected to continue to grow at an exponential rate in the very near future, as well as the long-term future. So the trade desk is pretty self-explanatory. I think that because Meta came out better than expected, because Google came out better than expected, because Amazon's advertising business came out better than expected, because Roku beat expectations, I think the trade desk is going to be just fine. I think that they're actually going to come out, they're going to report really good earnings, but it's going to be about that guidance. Like, what is Jeff Green seeing? are they going to raise guidance? Because the times that the trade desk does sell off after earnings is usually when they guide down on something. So like that's what I'm going to be paying attention to there is like, what are they seeing from a macro perspective? Like what are their expectations are for, next quarter in a full year basis? Because that is going to be the reason why it ends up selling off. And if it does sell off, it's pound to table buy. Like the trade desk is one of those companies that if it gets down to a reasonable valuation, I'm going to be there to buy it. For better context here. So I actually pulled up the EV to EBITDA multiple of the trade desk, and you can see that historically it's a very volatile stock to own at certain periods. But like when I started buying the company, it was like right around in here. I think I actually bought it throughout 2022 when it was trading at a forward EV to EBITDA of like less than 30. And I remember running the numbers. I was like, man, I actually have to buy it here, because I'm not sure if I'm ever going to get it here again. I think that there was a little bit, there's a time there back at that October correction. No, I guess not. But like after earnings, just a couple, I think like 2 or 3 quarters ago, they actually ended up selling off pretty heavily. But once again, that was a buying opportunity. And I do think the trade desk, if it does fall on any sort of weakness in forward guidance, because I'm pretty sure they're going to beat expectations, I do think it's a buy. Okay, that's all I got here for you guys. This has been a really long one here. Been a really long live stream. To really simplify, we're in full swing with earnings season. I'm going to be busy. There's going to be a lot of earnings that I'll cover. I'll be talking a lot about that on both X and then also on my Savvy Trader, just making sure that the subscribers there always have access to like everything that I'm thinking about, the moves that I'm making, and then more importantly, like how am I planning out this? Because I do have 22 stocks. Like how am I going to narrow it down to 15? And what are going to be those top 15 stocks, right? And I think that as it stands here today, it seems like the tech is actually bottoming in the markets. When you look at the multiples, especially on a broader basis. So like if you just took the software multiples out and if you got rid of Palantir, CrowdStrike, Cloudflare, and Samsara, IoT, ticker symbol IoT, that actually multiples in the small and mid cap tech stocks, like they're actually super compressed right now. So for example, I think it's Zscaler is trading at less than 10x Monday. SentinelOne, those are 3 companies right now that I think are actually trading at really, really solid valuations, that if they beat earnings, that there's tremendous upside to these companies, especially after they report. But that's all I got here for you guys for this week. I'm going to make sure that I come back up here. There's really no macro data this week. The name of the game is actually going to be earnings, which is why I spent so much time covering earnings on this live stream here today. But obviously, as always, guys, you stay classy. And until next week.